my introduction to stock accounts for a teenager explained by a teenager. Okay, let's get right into it. Straight away, people are gonna go like, why should I open a stock account when I can just spend all my money now and just have a great life? And I heard like stocks are risky and investing in certain assets is very, the market can be volatile. I can lose all my money. Stuff like that, which I will be addressing in this video. But for the time being, just know that overall the market, which if you don't know, is just stocks, bonds, and all of those fancy financial stuff that the Wall Street people talk about, the market tends to go up overall. So you will be getting more money in the long term if you stay in it and you be patient. And types of stock accounts. So basically, the whole premise of this video is just to talk about types of stock accounts. This can be individual, this can be offered by your employer, it can be a healthcare plan, not necessarily revolving around stocks, but it's still worth to mention all these things. So yeah, let's get right into it. So before all of that, I know we had a lot of introductions, but we have to basically address what is post-tax and what is pre-tax. So a post-tax stock account is basically, it's your income that is already taxed that you put into your account. So let's say I get paid like $2,000 a month, right? And I get taxed 20%, right? So I do pay $400. Actually, let's just keep it simple. Let's say I get $1K a month, I get taxed 20%, so I pay $200 worth of tax, right? I can use that rest of that $800 and put it into what's called a post-tax stock account, which essentially is a stock account where you contribute money using money that you already paid taxes for. So you pay tax now, which is the income that you put into a post-tax account, and you withdraw the earnings that you got from that tax account tax-free once you retire. Okay, now moving on, a pre-tax investment account is basically you pay tax later, and you can contribute money to the pre-tax account with deductions, and I'll tell you what deductions is in a bit. So basically, a pre-tax account, you don't pay taxes on the money you put in right now. But once you take all of the money out, you have to pay taxes on the capital gains or the earnings that you got. Alright, so what does deductions mean? Deduction basically means that, let's say I make 1K a month, right? And I get taxed at a 20% rate. If I deduct $200 from my taxable income and I put it into a pre-tax account, that $200 that I put in to my pre-tax account doesn't get taxed. So let's say I have $1,000, right? I put 200 into a pre-tax account. The rest of the 800 I don't have to pay taxes on because my tax rate is still 20%, right? So I end up with $800, and the $200 I put it into a pre-tax account where I don't have to pay taxes now. It's deducted from my taxable income, but later on I can pay taxes on it. I have to pay taxes on it because it's a pre-tax account. Okay, that might have sounded hella complicated, but you're gonna have to remember all of this. Probably there's someone who explained it much better than me. Again, I'm just a teenager. I'm not a financial expert or a Wall Street person, but if you want to know what post-tax versus pre-tax, just search up Google or just, talk to ChatGPT. They should explain it a bit easier than me, but this is how I view it in my own words. Okay, now with all that being said, let's actually get into the meat of this video. Brokerage accounts. So you can't buy stocks or trade any of, financial assets without a brokerage account. So a taxable brokerage account is basically a regular investment account for stocks, which are like bits of a company that you can own, which you can grow. ETFs, which is a lot of stocks put into one fund, which is an ETF, an exchange traded fund. And mutual funds. Mutual funds is the same thing as ETFs, except there are a tiny bit of differences that I won't get into this video. So taxable brokerage accounts, there are no contribution limits because you put in money now and once you sell it, the stocks, you will get taxed a lot on them, more than like Roth IRAs and other like taxable brokerage accounts that do have limits. But there are no contribution limits, so you can put as much money as you want into it, and you are taxed on dividends, interest, and realized gains. So dividends basically is when you own part of a company like a stock and they pay you a certain amount per quarter or per year, free of charge. The company just gives you that much money as an incentive to get more investors. Dividends only are available in certain companies, like Home Depot or Target, for example. They pay dividends, but other companies like, let's see, which ones don't pay dividends? There are a lot of like Amazon, for example, they don't pay dividends. Nvidia pays like a lot, like a very small dividend. Just know that dividends, company gives you a certain amount of money, and they give you that as an incentive to draw more people in and to hold their stock. So yeah, you'll be taxed on dividends. Interest, which is basically like, interest is like if you borrow some money, you will have to pay money back, or if a company, for example, if they get money for you, they will pay you a certain percentage on interest. And then realized gains is pretty much just profit, right? So let's say I buy a stock for $50, sell it for $100. Since I gained a $50 gain from selling the stock, I will be taxed on that $50. Okay, now going on to joint brokerage accounts. Basically, it's just a brokerage account, the same thing as this, a brokerage account, but it's shared between two people or more. And custodial accounts is something that I currently use. It is for minors, managed by an adult until the age of the minor becoming 18-year-olds, right, or a majority. So essentially, my dad, he currently gives me a Vanguard custodial account, and I can trade stocks whenever I want to, but it is managed by my dad. Technically, it's under my name, but he owns it until I'm 18. So until the age of majority, he owns it, but once I'm 18, it turns into my possession. So those are the types of accounts that you can get, and we'll talk about the nitty-gritty stuff on the next slide. Okay, so tax advantage retirement accounts. These accounts basically have tax benefits, and they're used for retirement, obviously. So we have a traditional IRA, and if you don't know what an IRA is, it is basically an individual retirement account. So whenever you see IRA, just think individual retirement account. So individual accounts, there's a traditional IRA, which is basically, again, going back to tax deductible and stuff like that. If you see any of these red, it means that it's pre-tax. If you see any of the green, it is post-tax. So traditional IRA, it is a pre-taxable account, pre-tax account. Contributions may be tax deductible, which means that if you put money in, as we explained earlier, it will be deducted from your taxable income. So growth is tax deferred, withdrawals taxed as income. So basically, you know, when you withdraw money from that account, you will be taxed as income. So if you, let's say you have $10,000, you gain $5,000, and if you withdraw from that $5,000 that have grown, you will be taxed as that, as income for that $5K that you withdrew, because it will be an early withdrawal fee. Okay, wait, sorry. If you are withdrawing the $5K, you will be taxed as income. And if you withdraw $5K before you hit retirement, you will pay extra penalty fees. And the limit is $7,000 before 50-year-old, and if you're over 50, you can pay $8K each year. That is the limit as of 2025. And you might ask, oh wait, why is it $8K for people after 50? Are they just helping out older people? Yes, they are. So essentially, if you have not been investing before the age of 50, you're kind of behind, right? So they throw in an extra $1,000 for you to catch up and put money in. Okay, Roth IRA. This is my favorite tax account, tax-free account for investments. It's probably the most common one that people use. I know a few friends that have Roth IRAs, and if you go online, there's a lot of people that talk about Roth IRA, Roth IRA, Roth IRA, right? So essentially, a Roth IRA is a after tax dollar account. So you get taxed on your money and then you put it into that account. And once that money grows until retirement, once you take that money out, you don't have to pay any taxes on it, which is why the Roth IRA is so powerful, right? So withdrawals are tax-free, 7K limit before 50 and 8K limit after 50 each year. Okay, so same thing as traditional IRA. If I were you, I would choose a Roth IRA because it is the same limit, and this one you take stuff out as tax-free, and then this one you put stuff in and it's tax deductible, but once you take it out later, it is taxed. I choose Roth IRA because, you know, once you get older, you don't have to worry about, oh no, I have to pay taxes on my withdrawals and all my contributions over the years. I can just put 7K a year, and then once I'm like 60 or something, once I have a few million in the account, I can take all of those millions out tax-free and just spend it on, I don't know, a Lambo or like whatever I want at that time. Okay, so all of this looks nice and stuff, but this might be a bit confusing. I said 7K, and once I'm 60, how is it going to grow to millions of dollars? And that is a great question. So if you look at a compound interest calculator, which if you don't know, is essentially how much interest you are getting on your money invested. So let's say I choose a Roth IRA, right? I invest exactly $7,000 a year, right? So let's say I start investing right when I'm 18. So once I'm 65, Roth IRA is 59. So 59 minus 18, what is that, like 41 years? Yeah, 41 years. So you can start withdrawing stuff from your Roth IRA at 59. So let's say I start investing at 18, right? I have an initial deposit of $1, and my estimated rate of return is a conservative 8%, which is your rate of return essentially is how much you get back per how much you put in. So let's say I put $100, right? And it grows by 8% each year. So on the first year I put in $100, second year I have $108, and then the third year I have $108 times 0.08, which is times 108%. So each year it's growing by 8%, right? So the compound frequency is basically how much this 8% is compounded. So we'll put it as annually because our 8% usually compounds annually, and our contribution amount each month, or annually I guess, we can say it's 7K, right? Because that is the limit, right? So $7,000. And look at that. So with an 8% return annually after 41 years of growth and $7,000 invested annually, I will have almost $2 million in the bank, tax-free, able to withdraw. Now, you might be asking, wait, how did I have like all of this green? You see the green curve right here? That's how much you got back, right? That's how much money you got back. This blue right here is just how much you invested over the years, right? So all of this green is all of the earnings that you have gotten. The blue is the principal that you invested, or the money that you actually put in over the 41 years, right? So this is where people go like, oh, that's where the millions of dollars comes from, right? So if I invest only $7,000 each year, which over 41 years is almost $300,000, I'll be getting over $2 million worth of investment growth, tax-free as well. So you're pretty much getting $1.6 million tax-free. That is a lot of money. And if you spent it all on like Balenciaga, Gucci, whatever, like Pokemon cards, video games, going out to eat, you get it, right? All these things, and you don't invest it, if you spend this 300K over the years, you're missing out on so much potential here. I'm talking 1.7 million dollars, 1.6 million dollars, right? If you just stayed a bit more frugal, you know, you could still splurge here and there, but if you stay frugal and invested up to the limit for Roth IRA, you will get so much money, which is why I love Roth IRAs. This is why you have to invest. This chart is not only for Roth IRA. You can put in like more money. Some accounts don't have a contribution limit, some have a higher contribution limit, but this is how your money would look if you invest it over time. Now you got to start investing now, because if you don't start now, it will hurt you. So like, let's say you start at 50, right? And you have an 8K limit after 50. Sure, you're putting like $8,000 each month, but since you're 50 years old and the Roth IRA limit of age is 59 years old, or you can start withdrawing at 59 years old, from 50 to 59, that's only 9 years. Yeah, you're putting in $1,000 more each year, but look, you're not getting almost $2 million. You're only getting $100,000, which may sound like a lot, but look, the gap between the blue and the green, that is very insignificant compared to the gap we had here. Right, this gap is way larger than this gap right here. You see, the more gap between the green and the blue, the more profit you're getting, right? So if you start late at 50 or any age, if you start later, you will have less compound interest. You'll have less years for your 8% gain each year. So it's better to start now, even if you put 16,000, right? Even if you put 16,000, which is more than double 7,000 for 9 years, you're only getting like 50K, 55K here, right? So even if you put more money and you invest later on, and you wait and put it aside, put an investment aside and procrastinate on investing, you're getting less returns even if you put in more money. That is the power of compound interest, right? It's like a snowball effect, right? So let's just say hypothetically we invest for 41 years, right? So at the start you get less money, but as time goes on, see the gap widens quicker. That's the power of compound interest. Okay, now enough yapping about compound interest and like the visualization of this. Let's go straight into employer sponsored accounts. Now this is probably the most popular one aside from the IRAs. Employer sponsored accounts are basically stock accounts, investment accounts that you can use that are offered by an employer. So 401k, probably the most common one used by private employers. Pre-tax contributions, so again, all the red is pre-tax, all the green is post-tax. Pre-tax contributions, tax on withdrawal. So you pay little tax now, you have the tax deduction, but once you withdraw all that money, you have to pay capital gains taxes and income taxes. Employer match is often available, so let's say you put in $10 into your 401k. Sometimes your company, if you're lucky, they will say, okay, you'll put in $10, we'll chip in $5. So we'll put in, wait, no, sorry, that is way too much. That's a 50% match. So let's say you put in $10, they'll put in 50 cents, right? They'll give you a 5% match. Now that might seem insignificant, but 5% here, 5% there, it's a lot of money. So let's say you make $1 a month, they'll spot you 5%, which is, you know, that is 5 cents, right? That might not seem like a lot, it might seem insignificant, but as time goes on, that 5% would matter a lot. Okay, so that's the employer match. Now, basically, the limits for all of this is much higher than a IRA, so it's much higher than an individual retirement account because it is employer sponsored and most people use these, and the most you can put in is $23,000 and $500 if you're under 50 and $31,000 after 50. Now, just for fun, we'll look at all of this visualizations on the chart later, but since all of these are the same contribution limits for each year, I'll pretty much be like kind of skimming through these. But basically, a Roth 401k is the same as a 401k, but it is after tax, and withdrawals are tax free. So essentially, think of a 401k as just an IRA account, a traditional IRA account, and a Roth 401k as a Roth IRA, but they're employer sponsored. So this one is pre-tax, this one is post-tax. So the contribution limit is the same, so after tax withdrawals are tax free. 403b is the exact same thing as a 401k, except it is for government employees, right? So public schools, nonprofits, and some hospitals. Basically a 401k with the same contribution limits. Now let's pull up the fund chart right here. So 23k. Let's say you start working at, I don't know, like 22, because that's usually when people get a job after college. So once you're 22, if you graduate college at 22 and you start withdrawing once it's retirement age, so 65, you'll have like 43 years of investments with the initial deposit of $1, because you're not really putting anything in until you get, you know, your paycheck. So you will have a compound interest frequency annually, an 8% return, and a contribution limit of 23.5k. So 23.5k annually, and as you can see, bam, $7 million, right? And you're only putting in $1 million over 43 years. That might seem like a lot of money, which, you know, $1 million is, but look at that return. You get $6.7 million at the time of retirement. That is a lot of money, right? So that is the beauty of all of the employer-sponsored accounts. A key takeaway is that a lot of employers do have an employer match, which basically they spot you 5% of the amount that you put into the employer-sponsored account. That's why it's very appetizing to like use these employer-sponsored accounts, because usually they give you a pretty generous match. Okay, so going on to education savings accounts. So there's a 529 and a Coverdell ESA, and both of these are post-tax. And a 529 plan is basically educational expenses. I'm talking books, you know, stuff like that. Tax-free growth for qualified expenses, and you can contribute up to 18k per year, per donor, per beneficiary, and it is gift tax-free. So basically, you can donate, not really donate, but you know, like let's say your parents want to give you money for your books or board or whatever. They can contribute 18k a year for your college fund, and this is per beneficiary, so per person. And then married couples can give their children 36k per year for like education expenses, right? And then you can also do a super fund, which is essentially you do all 5 contribution years in a single year, and you can do up to 90k per beneficiary, which is usually per student in 2025. So yeah, pretty neat plan. I will definitely be using it if I were to go to college right after high school, but fortunately, I will be going to the military, and they will pay for my education expenses, so I won't have to be worrying about this. But a lot of you guys watching, if you haven't went to college yet, or if you're even in college, you should utilize the 529 plan. And the Coverdell ESA, it's an education savings account with contribution limits up to 2,000 a year. So just think of it as an investment account or a savings account where you can spot your kid up to 2k a year, which isn't like too much, but it is better than nothing. Okay, so health related accounts. So reason why I put this as pre-tax and post-tax is because you can choose whether it being a post-tax or a pre-tax account. So health related accounts, an HSA is for future medical expenses, and you do need a high deductible health plan or HDHP for this. And basically your contributions are tax deductible, grow tax-free, withdrawals tax-free for medical expenses, so basically anything related to medical stuff, break an arm, you know, you get a surgery, all of that good stuff, it will be covered by an HSA. And it is up to 4,300 per person and 850 8.55k per family. So that is the limit. And then a flexible spending account, which is pre-tax, is used for expenses not covered by health plans. So basically stuff like co-pays, you know, stuff that if your insurance doesn't pay for your vision, then you can use your FSA, your flexible spending account, for that. So, you know, if you have like United Healthcare or like Blue Cross, any like major healthcare provider, and they deny your claim, or they deny like certain health plans like vision plans or dental, you can use your FSA for this. And it is employer-based pre-tax for medical costs, and it has a 3,300 limit each year, and it's use it or lose it. So basically you can contribute 3,300 a year, but if you don't use it, then it doesn't roll over to next year. You have to use it in this fiscal year. So make sure to use up to your limit when you're doing medical expenses, or else it will go away the next year. Okay, other special accounts, SEP IRA, which is a simplified employee pension, which is basically if you're self-employed or a small business owner, in 2025 you can contribute less than 70k or 25% of the employee's compensation. This is a pension, so it isn't really related to a stock account or an investment account. It's really when you are retired, you can start taking money out of a pension, which, if you don't know, is essentially once you're retired, you can take money out of what's called a pension, so you can retire without working. So let's say I start working at 20, I retire at 65, and once I retire, well, if I don't have any money invested from any stock accounts, which you shouldn't do, you should listen to me and invest, you can still go back to your pension, which if your business offers it, basically it's a fund that gives you money over time to cover, like, you know, your rent, stuff like that. You can spend your pension on whatever you want, but usually people spend it on like housing, food, and other stuff, right? Simple IRA is very similar. It's for small businesses with employees, so it's not for self-employed people. And in 2025, the simple IRA contribution limit for those under 50 is 16.5k, and people aged 50 or older can make up a cash-up contribution, adding onto the initial 16.5k, adding additional 3.5k with a total of 20k. So if you're over 60 and you're from 60 to 63 and you still haven't contributed, you can add additional 5.25k onto the 16.5k, bringing your total contribution limit per year to $21,750. So it is very, very nice for small businesses and employees, but for most of you guys, you'll be looking at 401ks because you'll be working for a larger company. And yeah, those are simple IRAs and SEP IRAs, not very universal throughout the United States, just because, you know, it's for small business and self-employed people. Okay, a solo 401k. Solo 401k, this is, again, it is pre-tax, and it is for self-employed individuals, right? So let's say I want to become a YouTuber, which, you know, that'd be nice, but it probably won't be my main job. I'll probably be going to college soon after the military. So let's say a YouTuber, they are self-employed, right? Because they employ themselves, they make YouTube videos, they don't have a boss to speak to, they don't have a manager. Some of them do, but a lot of them don't. You are self-employed at the end of the day. If you're a YouTuber, if you are like an influencer, if you're an entrepreneur that works for himself, you are self-employed. So for 2025, the maximum contribution limit for a solo 401k is 70K or 77.5K for those aged 50 or older, and at 81.25K for age 60 to 63. That is a lot of money compared to the ones before. This is mainly due to the fact that you are self-employed, so you are not getting multiple streams of income. It is mainly because you are solo. You don't have to worry about other stuff. You just use a solo 401k because you're using it by yourself. You can have other streams of income, but for the most part, people using solo 401ks have a small business or they're entrepreneur, which is why they have higher contribution limits, right? So this includes both employer and employer contributions. So most of the time you'll just have employer being yourself and employees, so you'll pretty much just be contributing yourself. As an employee, you can contribute up to 23.5K or 100% of your compensation, whichever is less, an additional 7.5K catch-up contribution for those aged 50 or older. So the employer, if you are an employer, as you, the business owner, you can contribute up to 25% of your compensation or net self-employment income with a limit of $350,000 in compensation considered for the calculation. So that's a whole lot of jargon. You don't really have to worry about the solo 401k because most of you guys won't be self-employed. You guys won't be entrepreneurs. Not saying that you guys can't, but for most people, they're working for a company. If you are self-employed, you'll be looking up these figures for each year and that much if you want your compensation and stuff like that for your employees and stuff like that. So don't worry too much about a solo 401k because it's mainly just for people who, you know, are self-employed. Moving on. So I mentioned pensions briefly on the previous slides, which is basically when you get a pension is when you retire. Your company offers a pension. It gives you enough money as like a thank you gift for you to like pay for your housing and stuff. You can use your pension on whatever you want, but a pension, again, is not an investment account, right? It's not an account, but it's tax deferred, and it can be an investment vehicle, can be lump sum or annuity. So basically, if you want your pension as a lump sum, you can get all your money from your pension at once, but you don't get any money later on down the road. So my mom, she got a lump sum for a healthcare company that she worked for. She got, I'll just put it this way, she got more than 100,000 after working there for a few years, and she didn't want an annuity. She wanted it now because she thought that her company might like shut down in the future or whatever. So she decided to get all the bread right now, right? But if you don't want to get all your bread right now, you can get what's called an annuity. I hope I'm pronouncing that correct. I am. Annuity. So there's two loaves here, and there's slices, right? You get two loaves because usually over time, an annuity, you get more money than a lump sum. Lump sum, you get it all at once, but annuity essentially is, you see all these slices, right? These slices of bread, they get you all of this bread over time. So instead of giving you all the money at once, they give you, like my mom got over 100K. Let's just say she got 100K lump sum. Annuity, they'll give you 2K this month, 2K the other month, 2K the month after, and an annuity usually is until the day you die. So they do give you more bread over time. So there's two loaves of bread here. You get more bread over time, but you get less bread per time you get the annuity. So basically you get more bread over time, but you get bread spaced out in little intervals. But lump sum, you get all the bread right now and you get less bread. And my source is ChatGPT, and this is not because I don't know any of the topics that I'm talking about. It's just because if I were to use all the sources that I were to use in this video, it would be like 5 pages long, and I used ChatGPT basically to summarize the main points that I had. And okay, that is the end of the video, but if you don't know any of the stuff that I just mentioned, that is because there are a lot more there to it than just all of these accounts. So I will be explaining more later in this video on like why did I choose an 8% return, right? Why did you just talk about brokerage accounts? Where do I get a brokerage account? Stuff like that, right? So if you want to have more information on stonks, you can stay or you can leave this video taking all of the different investment accounts into account, but it won't really matter if you don't know where to get an investment account, which funds to invest in, stuff like that, right? So if you want to be like this guy, you know, big stonks, you should stay into this video and I'll teach you guys, you know, what is an ETF, what is a mutual fund, what are stocks, you know, where do I open a brokerage account, where do I open a stock account? Well, those two are pretty much the same thing. So basically all the stuff that I mentioned before, why open a stock account, brokerage accounts, those are basically just stuff, different types of stock accounts. But there is more to come, so I know this is a long video. If you want to, you can hop off now, but I will be talking about more in the next section. Alright. So I just finished making the next section, so we will go over the next section. Alright, so if you don't have a stock account, if you don't have a brokerage account, you cannot trade stocks, you cannot hold stocks, all of the things that we have done before you cannot do. Alright, so big financial firms, you might have heard of them, like Vanguard, Fidelity, Schwab, Robinhood, you know, those big companies, financial firms offer what's called a brokerage account. And brokerage accounts are what you can use to buy certain stocks. So brokerage accounts offered by financial firms are usually for your IRAs, for your individual investment accounts. If you're talking about 401ks, that's something completely different. You can't buy individual stocks on that. You can only buy ETFs and mutual funds, which we'll be going over in the next few slides because I only touched upon that briefly. So with that being said, you have to open a brokerage account from a financial firm, from like a trusted financial firm. All of these are trusted, by the way. I would personally use Charles Schwab or Vanguard or Fidelity, E-Trade. Those are the big banks, the big financial firms. Those are always going to be here. They're very credible. I personally use Vanguard. My dad uses E-Trade. My mom uses Fidelity. I know quite a few people that use, you know, all these other ones, but those are the big ones. And Robinhood, of course, it's not on here, but it's a relatively new brokerage account that you can use from Robinhood, the financial firm that Generation Z and the younger generations tend to use it because the UI is a bit more like pleasing to say, not really, but it's like more intuitive to use, right? So if you are like me, a teenager, you can use Robinhood, or you can stick to like any of these big ones like Vanguard, Fidelity, Schwab, or what else? E-Trade, you know, the big ones. Anyways, if you don't have a brokerage account, you need to go to a financial firm and open one. They'll get like your information, like your social security number, your employment status, all of that. Don't worry, they're a big firm. They won't just like leak it because it's illegal. They have trillions of dollars in these firms, so they won't leak your information or else they're going to lose a lot of money by the government. So yeah, you need to sign up for a brokerage account from a financial firm, and then once you get approved, you can trade stocks. Alright? Okay, so what is an ETF? What is a stock? What is a mutual fund? I mentioned on the previous slides that brokerages, usually you're only using it to get stocks, ETFs, and mutual funds. So an ETF is an exchange traded fund. So it's a lot of stocks that a certain exchange, like for example Vanguard, has an ETF called VOO. Alright, now VOO is an ETF that has a lot of stocks in it. An ETF is an exchange traded fund that has a lot of stocks, a lot of different stocks scattered throughout, all part of one ETF. So think of it as like a pie, right? So part of the pie, there's an apple pie, part of it is a pecan pie, part of it is pumpkin pie. So there's all different types of pies, but it all adds together to be a big pie, right? Now, instead of a pie, think of the pie being, the whole pie being an ETF, and the different types of pies being stocks. Now, with that being said, all the different flavors of pies are like stocks, and the whole pie is an ETF. So there's a lot of stocks in an ETF. There's a lot of different flavors of pies in the whole big pie. Now, there are different types of ETFs, like there's tech oriented ETFs like the NASDAQ, whereas like big tech companies like Amazon, Google, Facebook, Nvidia, of course, Apple, you know, all of those companies are in the ETF. And there are like the largest companies in the US like Nvidia, Walmart, you know, those different company stocks are also in like the S&P 500, which are like the large 500 companies in the US. Okay, for now, all you need to know is that ETF is an exchange traded fund that each stock exchange, like for example Vanguard, Fidelity, they have a different fund, which each fund has a ton of different stocks, like a percentage of stocks, all in one pie. So a lot of small flavors of pies in a whole big pie. Okay, that is an ETF. A stock basically is a partial ownership of a company. So let's say I want to invest in Nvidia. I buy one Nvidia stock for $170 because that's how much one Nvidia stock is right now. With that $170 of stock, I get one share of the company, one share of stock, which means I own part of the company. The more shares I have, the more stake I have in the company. So if I have one share, I probably have like a fraction of a percent worth of the company, right? But if I own like 10% of the company, I'll have $420 billion worth of Nvidia. So I own 10% of the company. I earn 10% of the stocks of the company. Okay, so stocks are different stakes in companies that you can own specific to different companies. I can have a stock in Walmart, I can have a stock in Amazon, Lockheed Martin, Rheinmetall, whatever. A stock is basically a partial equity in a company, right? Okay, so basically a mutual fund is the same thing as an ETF, but you have a minimum deposit, so you have to have a certain amount of money you put in to a mutual fund. So ETF, you can put on however much amount of money you want to have. So if an ETF is $500 and you only have 100, then you'll have 1/5 of an ETF share. But if you have a mutual fund, let's say the mutual fund needs a minimum deposit of 1K, then you have to deposit 1K for the mutual fund. Now that's the main difference. A small, more subtle difference between an ETF and a mutual fund is that an ETF trades during the day. So the stocks trade during the day, so depending on the price fluctuations, the ETF will sell or buy stocks inside of the ETF during the day, and mutual funds only buys or sells stocks in the mutual funds before and after trading hours. Now, if you don't know what trading hours is, don't worry. Basically, it's when you're able to buy and sell stocks. I live in the West Coast, so the trading hours for me is 6 a.m. to 1 a.m. In the East Coast, it is 9 a.m. to 4 p.m. That is the trading hours. So don't worry about trading hours too much. But ETF trades during the day, mutual funds trades after the day ends. Now, you might ask, wait, why are ETFs trading stocks? Why are mutual funds trading stocks? An ETF basically works with the best company being rewarded getting a larger share of the pie, right? I mentioned how an ETF is like a big pie, and a mutual fund is basically an ETF with, you know, minimum deposit, and it trades later on after market closes. Anyways, an ETF is like a big pie, and the big companies, like let's say Google, Amazon, they get a bigger piece of the pie because they're worth more and they perform very well. And the smaller companies, they will get a less share of the pie because they're not worth as much and they're not doing as well. But the big companies, the better they do, the more percentage of the pie they get. So let's say there's a strawberry version of the pie and it's doing very good. That company's doing very good. And so Strawberry Corporation gets more share of the pie. They get more a bigger slice, and the companies that aren't doing too well, they will their share of the pie will shrink. So it'll shrink to a point where if they're doing too bad, they will just get kicked off, and then a different company that's doing pretty well will replace them. So an ETF, the beauty of an ETF is that ETF and mutual funds is that the best companies will stay, and they will get more share of the ETF or mutual fund, and then the bad companies will leave. So you don't have to worry about managing the ETF too much, because all of it is managed for you, and that is the beauty of an ETF and mutual fund. And a stock, well, that's where you're kind of screwed, right? Your company can either do really, really good and your profit goes whoosh to the moon, right? Or it can crash. So the beauty of ETF is that it's more diversified. You have more different flavors of the pie, and the better flavors will get bigger. The smaller flavors will, disappear and get less and get replaced by better flavors. And stocks, you only have one flavor. You're not praying, but you're pretty much praying that that stock goes up in the flavor everyone wants. Right. So that's like an easy way to explain it. There's a lot of nitty-gritty stuff that I won't get into, but that is what you need to know for now. Okay, so characteristics of stocks and ETFs. As we said before, ETF diversifies your portfolio, meaning it gives you more stocks, gives you more flavors of pie, whereas a stock you only get one flavor. So trading on so this is just like basically a table on like the differences of a stock and an ETF. So they both trade on exchanges. Stocks don't have management fees, I'll get to that in a bit. And they both have options trading, margin buying, short selling, accessible from brokerage account, which you need a brokerage account to get a stock or ETF. Transparency, control over capital gains. Okay, don't worry about options trading, margin buying, or short selling, because that is not in the scope of this video, and we will be discussing that later on. But as a beginner, don't worry about this. You actually want to stay away from this because it is very risky. High risk and high reward, which is what you don't want if you want to grow your money over time. Short and steady wins the race, right? This is like fast and like not steady, and it's very risky. It's pretty much like gambling, but yeah, it's like, just don't do this for now. Trust me, it's for the better. Okay. Accessible for brokerage account, obviously both of them have this transparency. So your company stock, they will give out like transparency on like, oh, how's the company doing, why is, they'll tell you. ETF transparency, they'll tell you which companies are in the ETF and stuff like that. And control over capital gains, yeah, that's pretty much given, right? Okay, so what is a management fee, right? So a stock doesn't have a management fee, and an ETF does have a management fee, and you're like, yikes, fees, I don't like those. Okay, so an ETF like VOO, Vanguard, the financial firm that offers VOO, which is the S&P 500 ETF. I'll explain what S&P 500 means in a bit. But the expense ratio, or the management fee, is 0.01. So every year there will be a management fee of 0.01 of the entire amount that the ETF is worth. So 0.03 times that much is how much you'll have to pay each year to have the fund managed for you. Because these big companies, they're not just managing an ETF for free, they gotta get like some profit, right? So yeah, though you'll get charged that much of $576 as of today, of the time making this video, which is $576. So each year they'll charge you 0.03% of your entire ETF value, which is this much right here. Don't worry about it too much, because a lot of ETFs give you dividends, which we mentioned earlier, which pretty much just offsets about the expense ratio or the management fees. Dividends are essentially like different companies give you different amount of money quarterly or yearly, just to get more people to invest in the company and retain current investors. So if you reinvest your dividends from all of the different stocks in your ETF, they will pretty much offset the expense ratio, and you'll have more money. You'll have a surplus of dividends. So don't worry about expense ratios too much, unless if it's like some like absurd amount. If it's like more than, I think the rule is 0.5%, you usually don't want to use that ETF. Because if it's 0.5%, that's going to eat into your returns a lot over time. 0.5% might not seem like a lot, but over time you're losing out on thousands upon thousands of dollars. So personally, I used to use VOO because I used to use Vanguard's. I still do use Vanguard's financial firm for trading stocks, but the better, the lower the expense ratio, the better the ETF is. So that's why you don't want a high expense ratio. VOO is pretty much like the best ETF for the S&P 500, which I will get to in a bit what S&P 500 is. There are other options like SPY, which is SPY. There's FIAX, I think is like the Fidelity version. I think that's a mutual fund though, but like ETF mutual fund, they're pretty much the same thing almost, which we covered earlier. There's SPLG. I use SPLG because instead of a 0.03% expense ratio, it's a 0.02% expense ratio. So yeah, that is that. Moving on. I know this is a lot of like yapping, but it is pretty important. Expense ratios will eat into your returns if they're pretty high. Okay, so ETFs like the S&P 500 and the NASDAQ 100. I mentioned S&P 500 a lot, and in my earlier section, I mentioned how there's an 8 to 12% annual return. Okay, now why is there an 8 to 12% annual return? That is because the S&P 500, which is the United States 500 best companies, the companies that are worth the most, all of those companies morphed into one ETF. They will average you around 8 to 12% annual returns. So if you invest $100 in 1 year, it will go from 100 to 108 or $112 usually. Sometimes the market will go down, like in the COVID crash in 2020 and the Trump tariffs that we just had in early 2025. So sometimes the market will go down by maybe 10-20%. That's called a recession, a bear market, or a depression. But as you can see in this chart, it usually just goes up over time, right? So on average, it goes from 8 to 12% up annually. Sometimes it will go down, sometimes it will go up, but that's just how it goes. It'll go up over time. So that's the S&P 500, the ETF carrying the S&P 500 or the 500 top US companies. Now let's talk about the NASDAQ 100. So the NASDAQ 100 is also some top companies, but it's the top US 100 tech companies. So we're talking about Nvidia, Amazon, Google, Microsoft, Apple, stuff like that, right? And you're looking at this like, whoa, minus 33.5% and 42.6 annual returns. That's a big contrast to 8 to 12% annual returns, right? And yeah, you'll be correct. And the reason why it's so volatile, you see, big crash here, big crash during COVID, that is because it is a tech company and tech tends to move pretty fast, and just some small news can alter like tech companies' stocks a lot. Because it is tech, it usually moves faster in the US markets. So you will expect to get a lot of returns, higher returns, but higher risk. So if I were to manage like a Roth IRA, I would put 60% of my money in an S&P 500 S&P 500 ETF, and then I'll put 40% in a NASDAQ 100. NASDAQ 100 is if you're really risk taking, you want more returns, but you are not afraid of that much risk, stick with the NASDAQ. If you want steady returns but not that crazy risk and moderate returns, stick with S&P 500. Both are very solid. I would recommend having half and half or 60-40 balance. Just it's better to have both of these and not all your eggs in one basket like the NASDAQ and S&P 500. And the beauty of these ETFs is that they diversify your money over all of the stock market, right? So S&P 500, all top 500 companies, NASDAQ 100, top 100 tech companies. So don't worry about, oh no, Nvidia just died, or Microsoft just died, or Walmart just died. If not died, but if their stocks crash, it will only go down a tiny bit, right? Because other companies will do good and they will carry the price and the momentum upwards, like what you see here. Okay, and you're probably wondering, what? I don't want ETFs, I want stock accounts. Like, look at Rheinmetall. Look at Nvidia, you know, they're going up all the time. You know, why can't I just invest in stocks? And you're completely right. I agree. It's better to have a mix of both ETFs and individual stocks, because if you only have individual stocks, they are more volatile and you are more susceptible to losses. Sure, you can have like really high gains here. Nvidia, Environmental, you know, those are two very nice tech and defense companies. But what if it crashes and it goes to like zero? Like, remember what happened to Yahoo? Remember what happened to AMC, GameStop, you know, those companies? You should invest in ETFs and stock accounts. And the reason why I mention ETFs and mutual funds is 401ks cannot have individual stocks. They can only have ETFs and funds only. Only IRA, Roth IRAs, or individual IRAs, traditional IRAs, and IRAs, which are individual retirement accounts, can have individual stocks, like this and this, right? Now, IRAs can also have ETFs. They can have a mix of both. Like, you can have some shares of Nvidia. You can also have some shares of S&P 500 stocks. Whereas 401ks, you usually can only have mutual funds and ETFs. So IRAs have more flexibility, you have more control over it. You can have stocks and ETFs, where 401ks, you can only have ETFs and funds. That's usually how it goes. There are some exceptions. Alright, on to the next slide. Okay, now this isn't too much about stocks, but there are other assets like cryptocurrencies like Bitcoin, Litecoin, Solana, stuff like that, right? Wait, no, that's not even Solana, that's Ethereum. But okay, Bitcoin, Litecoin, Ethereum. Okay, so cryptocurrencies are essentially like a different type of currency, not necessarily dollars, but they can be worth dollars, euros, Japanese yen, whatever, right? Basically, it's a currency that allows you to send and receive money without a middleman, without a bank or a government, right? So that's crypto. That's another asset, which is a type of investment you can have. Crypto is very volatile, so if you're a beginner, you want to stay away from it. Aside from Bitcoin, I do have some money in Bitcoin right now. It is going up quite a bit right now, but just know that it is a bit volatile, and it is often the price is reflected off hype, which, you know, usually if you want to have a conservative, very slow and steady portfolio, you don't really want to diversify everything into Bitcoin, for example, right? So if you have extra money, of course, put it into Bitcoin, put it into crypto, but I wouldn't put more than 5% of your portfolio there if you were to start out. Okay, so bonds, basically a bond is an IOU, right? So the government has a certain amount of money they have each year that they need to spend, and they borrow this money. If they have a deficit, they borrow the money using bonds. If you buy a government bond worth $1,000, it's basically a certificate that gives you $1,000 worth of government money. And once the bond expires, so let's say I get a bond in 2025, it expires in 2026. I buy a bond at a 5% interest rate in 2025. Once it expires in 2026, the US government will spot me 5% or $50. So I put in $1,000, I get $1,050 back. That's how bonds work. Basically, government IOUs, treasury bills, bonds, pretty much the same thing. They'll give you interest rate, and you can't touch the money until the bond expires. Pretty neat for some guaranteed investments. Bonds are the most secure investment aside from gold, but that's a whole different story. It's not related to this asset class too much. It is a different asset. Gold is a different asset, but we won't be talking about it in this video. And a CD and a HISA. So a CD is a savings deposit, pretty much the same thing as a bond, but usually done through a private company. So my friend, he had a CD at Bank of America. CD, let's say you put in $1,000 and it's locked at a 4% rate. So after your CD expires, it gives you this certain 4% rate or whatever interest the bank wants you to get. You can sign up for different CDs, just shop around for the highest rate and whatever you need. They are pretty nice. If you are not too responsible with your money, they lock your money in there. You can't take any in, you can't take any out. it's locked there until you get the interest rate once the CD expires. It's very nice for short-term investments. Very, very safe investment. HISA, so a high yield savings account, or a HISA, is essentially a bank account that gives you a high yield savings account. A high yield, right? So instead of like a traditional bank like Bank of America, Chase, Wells Fargo giving you a 0.01% interest on all the money you have each year, a high yield savings account that are offered by like SoFi, which I will be using soon, give you a 3.8% annual percentage yield, 3.8% interest instead of a 0.01% interest, which is 380 times more than other banks. So basically, your money in a high yield savings account is a boosted rate from 0.01 all the way to like 3.8. I think the market rate right now is around like 4%. It's basically, it gives you 4% interest, or however amount the HISA will give you. It gives you more money, more interest per your checking account or savings account. It gives you more money essentially than a basic normal checkings account, a normal bank account. So yeah, that's pretty much CDs and HISAs. Real estate, this isn't really related to the video, but yeah, you can diversify your portfolio with real estate. You can buy houses, you can get a mortgage on a house, you can refinance. That is a whole different video, and I won't get into that. Okay, so funds for your retirement plans. These are all the funds. I'm not going to read them all because it's quite a bit, to be honest, and this is only for Fidelity. So if I have Fidelity, I can have all these funds. If I have Vanguard, I can have all these funds. These are the different funds that you can have for your retirement. So you can put these into your 401ks, your 403bs, all that fancy stuff. So these are the different funds, ETFs, mutual funds for your retirement. You can use any of these. You usually want to just stick with the US equity index because that usually reflects the S&P 500. Then bond indexes are basically like ETFs and mutual funds for bonds, which we just talked about. Target date funds, those are like funds for a specific time you want to retire. International indexes are like ETFs for international, like for example China, India, Japan, the EU, Europe, UK. Those are like different ETFs for international stuff. Usually you just want to stick with the US because they do outperform like other countries. So bonds, we talk about target date funds. Basically, if you want to retire in 2050, you buy one of these. If you want to do 2060, you find one of these that make you want to retire in 2060. Active equity, we won't be talking about that because that is out of the scope of this video. Okay, so all of this doesn't really matter if my investments are going to go to complete crap. So I started investing last year. I put in $900 and I grew it to 300. I grew 300 to 1.2k, and then I bought a PC with it because my old PC died on me after 6 years. So it was pretty nice. I'm starting over again. I have like around $100, which isn't a lot, but remember, consistency is key, right? You got a dollar cost average, which just means you got to put more money consistently over time into your investment accounts. You got to max out your Roth IRAs, max out your 401ks, right? And over time, you know, millions of dollars, right? Just like the chart we saw at the very beginning. Okay, so in the course of 1 year, I gained 33%, mainly because I found a company called Rheinmetall. You saw the chart earlier. Rheinmetall was a very nice company, profited a lot. And the brokerages I use is Cash App and Vanguard. And I wouldn't really use Cash App because it's really only for small individual investors. There are a limit on how much money you can put in. So I only use it because it doesn't, Vanguard doesn't offer fractional shares for certain specific stocks. Only for Vanguard ETFs, it gives you fractional shares. So I do use Cash App. If I were you, I would to use Robinhood or Vanguard. If you want fractional shares, use Robinhood, Fidelity, anything works. If you want a more stable, you know, more conservative stock broker, use Vanguard. I use Vanguard, it's very neat. I use Cash App, it is very neat. Unfortunately, the only reason I use Cash App is because again, Vanguard doesn't have fractional shares. If you don't know what fractional shares is, it's like if I can't afford $100 worth of stock, if a company A is worth $100 and I can only, for $20 worth of company A, then I can buy company A for $20, right? But $20 is not $100. I can't buy it yet, so I'll own a fraction of a share. So I'll own a fraction. 20 over 100 is 0.2 or 20%. So I own a fraction of company A, and I'll own 20% of a stock. Not a full stock, only 20%. So if you want fractional shares, use like Robinhood or Fidelity. If you want like very nice mutual funds and ETFs, use Vanguard. Vanguard, you can use ETFs, fractional shares, but they can only be managed by Vanguard. So you can't use the Fidelity S&P 500 as fractional shares, only Vanguard, so only VOO, VGT, etc. Right? So yeah, Vanguard, very nice firm, Cash App. My dad didn't want me to use Robinhood because they don't offer UTMA or a custodial account, which we talked about at the very beginning. Custodial account is account used for kids, overseen by the parent. So Cash App allows you to get a custodial account for trading fractional shares. Vanguard, I do have a custodial account, but Robinhood does not. Otherwise, we would have chose Robinhood if they did offer a custodial account option. And okay, so I just want you to simmer down a bit. This is the end of the video, so congratulations. If you're listening to this, if you're watching this still, you are probably the 1% that stuck through this entire video, and it is a long journey. I know, just for this video, but your investment journey has just begun. Might sound cliche, but if you invest your money now, you will thank yourself later. Right. So if you don't invest your money now, it's going to be eaten up by inflation. If you spend all your money, it's going to suck. So in the future, you have no savings, you have no investments. Would you rather spend 300K throughout your entire life, or would you rather spend 200K throughout your life, and then once you retire, you have a few $1,000,000, $5 million to invest, or sorry, $5 million to spend? I'd rather choose 200K and then millions of dollars to spend. I don't want to spend a measly 300K right throughout my entire life. That's a lot of money, but it won't sustain me to like some really like cool stuff like a Lamborghini, a house, a mansion, travel around the world. You know, you can't get that with 300K, at least not in the future at least. So invest your money now, you'll thank yourself later. And yeah, if you enjoyed this video, please drop a like, subscribe. I spent so long making this video, and if you did enjoy, please use all of your money that you can, all the money you are comfortable with. Do your own research, do which funds you want to research, which funds you want to use, research whatever you feel comfortable with, and invest it as soon as possible, because compound interest that we discussed earlier is on your side. The sooner you start investing, the more returns you'll get, and your older self will be thanking yourself for it. So thank you for watching. Please like, comment, subscribe. I love you. If you slept throughout the entire video and watched or listened to all of this, please invest, please invest, please invest. You'll thank me later. Alright, I will go to sleep now. It is currently 3:57 a.m. and I will post this video soon, and I'll see you guys in the next video where I'll probably do something fun like a Pokemon card video. Anyways, goodbye. Lowchy out.